Equity markets are starting to feel the strain of a more hawkish Federal Reserve colliding with a tech-led shakeout and rising volatility. You are watching vTalkInsight, Equity Pulse Daily for June 24, 2026. Today we unpack how shifting rate expectations, stressed semiconductors, and an evolving AI narrative are reshaping risks and opportunities across global equities. The dominant macro story is a Federal Reserve that sounds more hawkish on inflation while markets still may not be fully pricing further rate hikes. Two-year Treasury yields have pushed to their highest level in over a year as officials signal a real chance of another move by September, yet equity pricing still leans toward a benign rate pause and soft landing narrative. Under Chair Kevin Warsh, the Fed has effectively scrapped detailed forward guidance, leaving investors to reverse engineer its reaction function from sparse comments and incoming data. That shift, combined with diverging views among policymakers, means every meeting is live and the risk of the Fed surprising a complacent market is rising, a recipe for higher equity volatility if expectations and actions diverge. Since the recent meeting, financial conditions have tightened through a stronger dollar and a lower 10-year yield, underscoring how hawkish the Fed looks versus global peers. The Japanese yen is hovering near its weakest level in 4 decades despite rate hikes and past interventions, and political uncertainty in the UK is weighing on sterling, so currency stress is adding another layer of fragility, even as credit spreads remain historically tight and the S&P 500's volatility index edges toward the high teens. Energy has swung from being the immediate inflation threat to a short-term release valve, thanks largely to temporary U.S. waivers that allow Iranian crude to re-enter the market. Roughly 30 million barrels have moved to Asia under a 60-day dollar waiver. Tanker transits through the Strait of Hormuz have rebounded from single digits to around 30 per day, and benchmark prices like WTI and Brent have slipped back into the 70s. The catch is that much of this surge reflects previously blockaded cargo finally clearing the backlog, while overall traffic through Hormuz remains far below its usual pace. Hundreds of merchant vessels and thousands of seafarers still need to be evacuated from the region, and once the backlog is worked off, flows are expected to slow again, limiting how much further prices can fall purely on supply relief. At the same time, global oil stockpiles have been heavily drawn down, with estimates that 6 to 8 million barrels per day are not reaching end markets. If physical bottlenecks persist and inventories are not rebuilt, several scenarios point to crude prices potentially jumping from the mid-70s toward $135 within weeks, a move that would quickly reprice inflation expectations and pressure both cyclicals and long-duration growth equities. Under the surface, equity leadership remains strikingly narrow, with AI-linked technology and energy stocks doing most of the heavy lifting for index-level gains this year. Without those pockets, the broader market would be negative year-to-date, and estimates suggest the top 10 names in the S&P 500 now make up well over 40% of index weight, intensifying concentration risk. The AI capital cycle is enormous, with infrastructure investment having tripled in 2 years to around $750 billion, roughly 2.5% of U.S. GDP, and forecasts pointing toward up to $4 trillion by the end of the decade. That spending is driving record office absorption in San Francisco, higher Bay Area rents, and strong performance in luxury real estate, but it also raises classic bubble questions as token costs fall, pricing power for hyperscalers shows signs of peaking, and some enterprise customers like Walmart and Uber start capping AI budgets. There are early signs of rotation away from crowded AI and semiconductor trades toward regional banks, healthcare, and cyclical sectors, helped by expectations for stable Fed policy rates and softer oil. Small caps and financials have benefited from anchored long-term yields near 4.5%, while investors increasingly seek equity-based hedges with negative beta to the AI complex, even as positive real yields of around 2.5% on government bonds offer a credible alternative to equities and encourage barbell-style portfolio thinking. The sharpest stress point right now is in global semiconductors, where an Asia-led sell-off has spilled across regions. The MSCI Asia Index is down roughly 3.5%, South Korea's Kospi has seen falls of around 8 to 10% with circuit breakers triggered, and the Philadelphia Semiconductor Index recently dropped about 8% in one session, having moved 5% or more on half of the last several trading days. Reports that SK Hynix could slow AI chip production, alongside its pivot away from everyday consumer electronics toward higher-margin AI memory, have amplified worries that the industry may be overbuilding capacity just as customers question the profitability of expensive AI deployments. Memory names are widely viewed as expensive, and there is growing concern that elevated chip prices could trigger demand destruction in end markets like smartphones and personal computers, especially with enterprise IT budgets growing only about 4% year-over-year. Micron Technology now sits at the center of this debate, with the company expected to report revenue growth of roughly 270% and earnings up more than 900% compared with a year ago, far above the broader S&P 500 trajectory. After a pre-earnings sell-off, any disappointment on growth, margins, or guidance could reverberate through the entire memory complex and broader AI narrative, while even a strong print will be tested against already elevated expectations and concerns about future overcapacity. Longer term, demand for AI infrastructure still looks robust, with companies like NVIDIA, Microsoft, and Meta racing to add compute and leasing data center capacity to firms such as Anthropic and Google, generating tens of billions of dollars in annualized revenue. Yet historical parallels to the fiber optic build-out, rising energy constraints, the prospect of quantum computing reshaping data center architecture, and the possibility that AI compute becomes commoditized all argue for a wide range of outcomes for current semiconductor valuations. Beneath the surface of strong trading volumes and tight spreads, the first real cracks are appearing in private credit liquidity. Apollo has repeatedly capped withdrawals from some of its largest non-traded credit funds at 5% of outstanding shares, even as redemption requests have ranged from the mid-teens to nearly 70%, and Morgan Stanley's North Haven Private Income Fund has imposed similar limits after requests exceeded 12%. At the same time, major technology firms, including SpaceX, have raised on the order of $300 billion of debt since November, fueling concern about leverage and balance sheet resilience if funding conditions tighten. SpaceX shares have already fallen about 60% from earlier levels and dropped 16% in a single day after news it was seeking $20 billion in investment-grade debt, while AMC plunged more than 20% on a dilutive equity raise to address its own debt load. Despite those stresses, risk appetite for new issuance remains strong, with mega IPOs such as SpaceX and potential listings from Anthropic and OpenAI signaling that public markets are still willing to absorb large, high-growth stories. Valuations for some new tech deals are reaching 100 to 140 times revenues with no earnings, even as Goldman Sachs is on track for record quarterly equities trading revenue above $5 billion, helped by AI-driven volatility and heavy Asian trading flows. Outside the mega caps, several company stories highlight how markets are rewarding AI enablers that pair innovation with tangible cash flow. Twilio has combined AI functionality with accelerating growth, operating leverage, and reduced stock-based compensation to deliver a roughly 30% year-to-date share gain, and it is targeting over $1 billion in free cash flow by 2027 after already generating about $132 million, giving it flexibility for buybacks or acquisitions. IBM has also enjoyed a resurgence, with its shares jumping around 4% on increased government investment and executive orders in quantum computing, plus its entry into OpenAI's partnership program for AI-powered cybersecurity and a broker upgrade. Further along the hardware stack, Cerebras is differentiated by a wafer-scale AI chip made with Taiwan Semiconductor and backed by a take-or-pay agreement with OpenAI, but near-term profitability is pressured by capacity build-out costs and heavy customer concentration, while Oracle's 21,000 headcount reduction underscores how AI-driven efficiencies are reshaping traditional software businesses. In more traditional sectors, FedEx is demonstrating the power of mix and efficiency, beating expectations with revenue up about 13% including freight, and expanding operating margins to 8.4% as it focuses on higher margin business-to-business volumes and network integration on the way to a $6 billion free cash flow goal by 2027. Nike, by contrast, faces rating downgrades, a chief financial officer transition, and questions about core segment growth despite reaffirming near-term guidance, while Porsche and Volkswagen grapple with weak Chinese demand, excess capacity, and pressure to simplify model lineups to defend margins. Healthcare and real assets offer a different set of structural stories, led by Eli Lilly, whose GLP-1 obesity drugs are seen as capable of generating around $130 billion in annual sales if they reach only 10% penetration, with potential benefits extending to cardiovascular, cancer, and neurological outcomes. In the resources space, Energy Fuels has assembled a vertically integrated rare earths chain from mining to magnet production, with operational mines and a Utah mill capable of producing about 1,000 tons of neodymium-praseodymium annually, placing it ahead of many pre-revenue peers and squarely in the energy transition and supply chain resilience themes that are increasingly important to equity markets. Pulling this together, equities are navigating a complex mix of a less predictable but still hawkish Fed, fragile energy supply, and a market structure dominated by AI and energy winners, even as semiconductors and private credit flash early warning signs. Volatility is picking up, sector leadership is narrowing, and dispersion across individual companies is widening, with balance sheet strength, cash flow visibility, and strategic alignment to durable themes like AI, healthcare innovation, rare earths, and the energy transition standing out as key differentiators. From here, the critical signals to watch include incoming inflation and labor data that will shape the Fed path, the behavior of oil inventories and Hormuz flows, the market's reaction to Micron and other chip earnings, and any further evidence of stress in private credit or highly leveraged growth stories. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.